The benefit of being able to analyze candlestick charts puts investors with the advantage that they can see that there's been no major change of investor sentiment. Once a trend has started, as we can see here in the Dow, we know the uptrend remains in progress on a very simple rule, that we need to see a candlestick sell signal and a close below the T-line. You can see how obviously the T-line's been a major support during this uptrend. That same analysis can be applied to the trend of the NASDAQ. So if you see one index up one day and the next one down, but they're still trading in this upward trend channel, it tells you there hasn't been any major change of investor sentiment. You're merely seeing shifts in different sectors being bought and sold. Now, the advantage, again, to candlestick analysis, it can easily identify which of those sectors are the strongest ones to be in. This can be illustrated by our analysis of Labu, the biotech leveraged fund. You can see the Morningstar signal. You can see the fry pan bottom. You can see the breakout of the fry pan bottom right here at this resistance level, telling us there's now a new dynamic in the biotechs. So whether you're trading the index itself, that's fine, but it also alerts you to go find the strongest stocks in that sector based upon candlestick signals and patterns. VRX was one of those that we identified because of the uptrend starting with a very strong signal. This is called the bullish flutter kicker signal. It's a kicker signal with a little flutter in between, but it sets up for a very high probability you're going to be in an uptrend. And then, as you can see, coming out of this pattern, our first target was the 200-day moving average. Now we have to see, once it's here, what type of signals we get. And we know that this is our first target, but we also know if this is wave 1, wave 3 could bring you up into this area based upon wave 1, wave 2, wave 3 reaction. The graphics of candlestick charts make it relatively easy to know when it's time to go short, as in you can see in the August live cattle, we had a big bearish engulfing signal. It finally closed below the T-line, and we're staying short until we see a reversal signal. Notice we had a hammer. It didn't confirm. Now we have a doji after a little gap down, and we're in the oversold area. This is telling us the probabilities are getting pretty strong, that if they open this positive tomorrow, you probably want to close out your short position, because we figure at least the first bounce will be up to the T-line and then possibly back up to the 50. So that risk-reward factor tells us that if we see a doji in the oversold condition and they open up positive the next day, if you're short, you cover your short position. Soybeans is another simple analysis. You can see there was a downtrending channel. At the top of that channel, we had a doji followed by a bearish engulfing signal, closed below the T-line. We knew when we started shorting what our next target was going to be. More than likely, the bottom of the trend channel down here in this area. So we're not trying to sell or sell at the absolute top. We're not trying to buy at the absolute bottom. We're trying to make our big profits in the high probability areas, going from one technical level to another technical level. That same scenario was applied to our analysis of crude oil, where you could see there was a downtrending channel. And when it failed right up here at the 200 with dojis and then a bearish confirmation back below the T-line, we knew where our next target was likely going to be. Back here to the bottom of this trend channel. That puts you in two situations. One, if you trade futures, you're short crude oil until you see a buy signal confirmed. If you're planning on buying crude oil stocks, you're probably not going to have as much incentive while it's on its way down until it bottoms out and starts back up again. That'll be it. We'll see you in the chat rooms.